Okay, we are recording and this is a sound test. Okay, that seems to be working still. That's so exciting. You have no idea how exciting that is to me because I have had like a saga getting my filming and recording to work, and it kept just stopping working randomly, like in the middle of recording. And the fact that it's still going, like, I'm stoked. I'm super stoked. So, anyways, you probably don't care about my like behind the scenes recording drama. I'm going to go ahead and dive on into today's episode, which is, what is today's episode? Right. Okay. Today's episode is sort of the second part to episode number 23. And episode number 23 was all about the first 3 things that you need to understand before you start thinking about investing in the stock market and investing for your retirement. So on the flip side of this, in today's episode, I'm going to walk you through the top 3 beginner mistakes that you have to avoid when you first start investing in the stock market. Before we dive in though, I want to say a quick hello and welcome to the How to Adult Show. I'm your host, Corey Fowler, and this is your source for all the important adulting life skills, like personal finance, that you wish someone had just taught you in school. So make sure you hit subscribe and let's get started. So whether you've already been investing for a few years or if you haven't started yet and are just in the process of beginning to learn a little bit more and kind of get your bearings before you start investing, this episode is definitely for you. Now, like I said a second ago, if you've caught any of the most recent episodes, you've heard me talk just a little bit about stock market investing before. And the most important point that I want to get across to most young people watching here, like yourself, is that investing in the stock market is not just for older people, it's not just for men or just for rich people, and it's actually a really integral part of planning and saving for your future. So much so that when we talk about saving for your future, we should actually be saying investing for your future because it's really difficult to save away enough money for your retirement without using the stock market to grow and compound your money. So if you're interested in learning more before you get started, which I always recommend you do, that is a very good idea and you're a smart person for being here, then make sure that you really digest and take to heart these 3 beginner mistakes that you need to avoid when you first start off investing. So diving into today's lesson, mistake number 1 that beginner investors will often make is trying to time the market. Timing the market means trying to make predictive decisions about buying and selling stocks to try to maximize your gain. It means actively managing your investments to try to always make the right decision about buying low and selling high. The problem with this, though, is that numerous studies and good old cold hard logic numbers, aka statistics, gotta love statistics, though these show us that nobody is ever really able to outsmart the system of the stock market. There are studies done where investors who try to actively time the market and make predictive decisions to maximize their gains are compared to a randomly they're compared to a randomly generated computer algorithm that makes similar trading decisions, and the random computer decisions performed better than the humans who are trying to make decisions to outsmart the system and buy low or sell high at the right time all the time. Now, it's important to note that this theory goes hand in hand with having a long-term investment strategy, which means being invested for tens and tens of years. So in the short term, it's totally true. People do make good decisions surrounding buying and selling one stock and sometimes end up making a lot of money for it. The whole overarching idea, though, is that in the long run, the wrong decisions outweigh the good decisions. And as a whole, people don't make as much when they're using more of a speculation strategy of trying to time the market. So trying to time the market and trying to pick stocks like this is basically gambling. And this is why there are so many people who are under the relative misconception that any form of being invested in the stock market is gambling. No matter how much you want to test this theory and no matter how smart you think you are, especially if you're just getting into investing and aren't devoting your entire life and career to understanding and working with this system, you just can't beat statistics. Don't try it. You just can't do it. You will not outsmart the market in the long run, so don't be that person. Even someone who's arguably won the stock market over the course of his life, Warren Buffett, is famously quoted as saying, "Time in the market beats timing the market." And what he's saying here is that a long-term and strategic buy and hold strategy that takes place over decades will always statistically win out over actively trading your investments to try and make more over the course of decades. The statistics show that this just doesn't work, ever, and statistics don't lie. So mistake number one you need to make sure not to make is trying to outsmart the market by timing it. Just don't do it. The second mistake that people will make is falling in love with a company or an industry or an idea and not being diversified enough. Now, I'm not here to sell you on the stock market or on any stock market-based products, and this platform is just all about sharing honest and real information with one another. So I just want to acknowledge that the stock market is volatile and there can be risks with investing, even if you have, or especially if you have really specific time horizons that you need to stick to. Stocks go up and down and the market goes up and down, and the idea is that in the long run, it will always go up. This is where diversification helps you weather through the inevitable ups and downs, and it's entirely possible that over the course of your investing life, a stock or an entire industry of stocks will crash or go down. By diversifying your investments, the idea is that you're mitigating that risk by not putting all of your eggs in one basket. Diversification can mean different things to different people, and there are numerous ways to diversify your investment portfolio. The most straightforward way is to make sure you're diversifying by investing in things like index funds, mutual funds, and ETFs. Now, I could do a whole other episode talking about what each of these things are, and how they work. But the important thing to learn here today is that buying any of these investment products means that you're automatically diversifying your investments because they're comprised of multiple stocks, just organized in different ways depending on what you buy. Overall, though, they each work a little bit differently, but as a whole, the idea is that diversification is built into the fund, and therefore safety and protection from the volatility of individual stocks is also built into the fund. Another example of diversification is investing in real estate or currencies. Overall, the idea is not to fall in love with one company or one industry that you think is on the rise and will always be on the up and up, and then put all your eggs into that one basket and potentially run the risk of getting burned by the crash that might happen if you're investing in one specific thing over a very long period of time, as you should be investing. And finally, the third mistake that beginner investors make is being impatient. Investing in the stock market and making financial gains from it is a long-term play. Looking at your accounts every day is not going to help you, and if anything, it's probably going to lead you to making some bad, questionable emotional decisions and freaking out at some point in time. For example, think back to the beginning of the COVID-19 pandemic. Woo, fun times. Markets took a dive. People panicked. People sold their investments at a fraction of their value and decided that they were just going to wait it out. But then the market bounced back, and it bounced back really quickly. So all of a sudden, buying back in was really hard for people to do without asking them to accept a huge loss. So if, like me, you're young and you still have decades to be invested in the stock market before you ever start to even approach needing to use those accounts in your retirement, treat it like the long-term game that it is. This also goes back to the first point, which is don't buy into the gambling mentality of trying to make short-term gains by timing the market. Make sure you remember the Warren Buffett quote I just mentioned, that time in the market, that means how long you're invested for, beats timing the market. Buying and holding and staying invested in the stock market for decades will give compound interest the time to work for you and do its magic. If you have no idea what I'm talking about there when I just mentioned compound interest, then for sure after this episode, make sure you go back and catch episode number 23, where I explain compound interest in a bit more detail. Like I always, don't worry, I'll link it in the description for you for the episode. So while this episode is all about the 3 mistakes to avoid when you start investing, episode 23 is all about the 3 concepts you need to understand as a whole before you start investing. So really, these two go hand in hand. Now, back to point number 3. I'm going to recap because I got distracted there. Point number 3 is don't be impatient. Don't be constantly checking your investment accounts, making adjustments that can get super expensive sometimes, and trying to just fiddle with it because you're nervous or because your buddy just told you about this new cannabis stock that you need to get in on the ground floor of. Investing isn't about winning or losing. It's not about beating the system or being the next rags to riches story, which is how most people think about investing. It's a long-term tool that's available for you, for everybody, to use to make sure that you have some very comfortable retirement years. And I will say it one more time, if you are young like me, this is a long-term play. Like, I'm talking longer than many of us millennials have even been alive for yet, which I know that's really hard to wrap your head around, but that's how this works. And it's easiest if you accept it, understand it, internalize it. And if you're still feeling like playing a game with some of your extra cash in the stock market, go play. I'm not going to tell you not to play, but please don't play with your retirement investment accounts. That's not what those are there for. That's not proper investing. That is gambling. So to recap, if you're new to investing, I recommend taking this episode to heart and making sure that you avoid these 3 beginner mistakes that so many people are likely to make when they first start investing. I'll say it to you one more time. Point number 1 is trying to time the market. Don't do it. You're not smarter than statistics. Don't let your little lizard brain tell you any differently. Accept it. Don't time the market. Number 2 is not being diversified. Don't fall in love with, say, the tech industry and put all of your eggs into that basket. Diversifying is really the only way to guard yourself against the inherent risks and the volatility of the stock market, and it will guard you well over time. And finally, number 3, being impatient. Don't be impatient. If you've just caught this episode, chances are you're a young investor like myself, and it's important to embrace the long-term nature of this type of savings plan. Don't drive yourself crazy by checking your accounts all the time. Just embrace the power of compound interest, know that it's working for you, and embrace that there's nothing sexy or fun about being an investor. It's a slow and steady wins the race kind of thing, and don't let anybody with a glitzy car and a 1 in a million rags to riches story ever tell you any differently. Now, before I wrap up, I want to make note that stock market investing is not for everybody to get started with right away. That's key. Before you start investing for your future, it's really important to make sure that you've got your present financial situation taken care of first. What this means is if you're still struggling to make your basic payments, please don't take a chunk of money and invest it in the stock market yet. Before you start investing, you need to make sure that you have your basic life needs taken care of. You should have a fully funded emergency savings account, and you should make sure that you're not carrying any sort of consumer debt or any other type of high interest type debt. And you also shouldn't be investing any extra money that you're really saving for something important like a down payment. So once these 3 or 4 areas of your financial housekeeping are in order, then you can look at starting to plan, save, and invest for your future. And when you turn your attention to it and work at it, it shouldn't take too long for you to actually get there. So If you want to get started, but you need to improve your personal financial situation a bit first, I recommend going ahead and signing up for the free beginner finance course that's currently being offered by the How to Adult School. This is a really straightforward, back to basics style finance course that spans 7 days. It's not full time, don't be crazy. And all it does is once a day for a week, it's going to send you a new little personal finance lesson that's quick to learn and that's going to have a fast and easy action that you can take to implement that lesson. So the goal is by the end of the week, you should start to be feeling much more confident about opening up your bank account finally and not living in fear of your credit card statements. And hopefully feeling ready to start working towards some of these bigger financial goals you've always dreamed of, but maybe never thought were possible for you. So if you want to sign up, you can find the link for the sign up page in the description for this episode or over on the blog, show notes for episode 25 at howtoadultschool.com. And I think that's it for today. Thank you so much for tuning in to today's episode of the How to Adult Show. If you're enjoying the show and this information here, please do me a solid and click subscribe on the channel and share it with a friend if you know someone else who might like it. We are all about helping one another out by sharing important information here and sharing knowledge that we all really should be properly taught at some point in our lives. So please join us as part of the community and start sharing the information that you love with your friends and or family. I will love you for it. They'll love you for it. And it's generally just a good thing. So thank you so much again. I'm your host, Corey Fowler, and I can't wait to see you right back here next Monday with a brand new episode of the How to Adult Show.